Yeah, well, thank you very much for having me here, and to Venture Cafe for putting this on. This is my first time, and I'm excited to have the opportunity to speak with you all. Um, my name is Casey Kidwell. I'm an attorney with Husch Blackwell in Omaha, Nebraska. Um, I am a corporate and securities attorney working primarily with startups in the tech space as they get started forming a corporation, an LLC, and then through the process of raising money from investors, and then onto a sale at some point in their business life cycle. My primary experience is with companies raising funds, though. So what I typically am working on is deals in the range of $500,000 to $5 million, sometimes less and sometimes more. For the most part, the mechanics of what happens here is the same, regardless of the amount of money. So I think that's a cool thing to keep in the back of your mind, whether you're raising 100,000 or 10 million. It's really the same mechanics and legal work behind the raise. So I'm here today to talk to you about seed deals and how to raise money from angel investors and venture capitalists. So I welcome questions throughout this presentation, this time, and hope I can teach you a couple of things, and hopefully I can learn a couple of things from you guys as well. All right, so starting off with just kind of what we're going to talk about today, I'm going to go over a few legal terms that don't mean a lot when you break them down. They're just a little hard to get used to if you're not in this space, and then talk about the different types of seed investments, hitting on the three major ones: safes, notes, preferred stock, and then really dive into term sheets for preferred stock, and talk a little bit about closing the deal. So starting off with terminology here, very basic terminology. I'll have to add some more throughout, but when we say an angel, that's usually just a wealthy individual that likes investing in startups. They are typically going to be what's called a follow-on investor. So they're not going to be negotiating with the startup directly, but they're waiting for somebody else to do those negotiations and then say, yeah, I'll agree to those terms as well, and I'll put my money in the pot with that investment. VC, a venture capitalist, these are typically professional investors who do this for a living, and they're often using other people's money to make their investments or make the investments on their behalf. So it's an important distinction because they usually have a bottom line to meet. It's a business for them. So something to keep in mind there. A cap table, otherwise known as a capitalization table, it's really just a snapshot of who owns the business right now or at some time. We sometimes use the term pro forma cap table, and in that case, you are looking into the future and saying, if all these conditions happen, this is what the cap table should look like. And then two important ones. This is just how I'm going to use these terms throughout the presentation. A safe is a simple agreement for future equity. It's a fairly common term now, but in the legal space, it's pretty new. The safe, I'll get into a little bit later, is a pretty new invention as far as a legal agreement goes. And then note is a convertible promissory note, and we'll dive into that one a little bit as well. So starting with the note, a note is just a traditional debt, like I guess you'd get from the bank or anybody else, but with one major difference. Upon certain conditions, that debt can convert into equity in your company. So there's going to be different conditions which would apply different types of equity and different amounts of equity. So we'll kind of jump through each one of those things here. Again, because it's debt, it's going to have a maturity date. You do have to pay this back unless certain conditions apply. Similarly, interest. We typically see a maturity date of 2 to 3 years on convertible notes, and interest in the range of 3 to 8%. So it is usually a little bit less than what you would, receive for a regular business loan from, say, a bank or another lending institution. But it's because it has that upside of we may get equity out of this deal. And then kind of the four major items that make convertible promissory notes different than traditional debt are these following four items here. And the first is the qualifying financing. So if I enter into a convertible note, upon what type of financing will that debt convert into equity? So you typically have two things here. The amount that it has to be sold and the type of security that has to be sold. So the amount is going to be typically what you expect to raise in your next round or similar to that. So if you're raising $1 million in notes, your qualifying financing may be $2 million. That may be what you expect to raise in the next round. Investors are often wanting to push that down, and you're wanting to push that up, that threshold of what qualifies. And similar to that, though, there's often a provision that's a non-qualifying financing, which gives the investor the right to choose to convert at that other non-qualifying financing. So for instance, if you only raise, using my previous example, you only raise 500,000 in that next round. Well, maybe the investor likes those terms. They want to convert over into whatever equity that person received or those investors received. The note investor is able to do so if they have that right. And the second part of the qualifying financing I'm kind of have avoided is the type of security that they're going to receive. So if we're talking about a corporation, you're generally going to have common stock up to the point where you are going out to reach and talk to investors. They're going to want preferred stock. We'll get into that a little bit later, but the qualifying finance is usually going to be an amount of money received, and it's usually going to have to be for sales of preferred stock. Again, there can be a non-qualified financing provision, though, that says it doesn't matter what type of security. So if you sell $1 million worth of common stock, the investor can decide to convert their note over into common stock in that instance. Another conversion mechanism is going to be that last one here, change of control. So this is typically thought of here as a provision where the company's either is bought out, before it closes that qualifying financing round. It's not incredibly uncommon for this to happen, so it's important to really work through this provision. And often investors want a premium. So if they put $100,000 into the company for their note, they may want $200,000 back if you sell the company prior to qualifying financing. Their theory there is, hey, we took a lot of risk on you. We should have that risk premium because without the capital that we put in, you wouldn't have been able to sell the company. That's negotiated quite often. It can just be you have to pay it off, but the bottom line is they're usually able to switch immediately prior to the change of control into common stock based on the value of that deal, so that they're able to at least get what they would have if it would have converted over to common stock at the time of the transaction. Two items that are very important from an economic point of view are the discount and fully diluted capitalization and how that term is defined. So the discount means is another kind of risk premium that the note investor is going to receive. So trying to use round numbers again, if the investor puts in $100,000 and the qualifying financing investors purchase your preferred stock for $1 per share, if there's a 20% discount, the note investor is going to convert over at 80 cents per share rather than $1. Again, a risk premium for putting their money in early when you're a more risky investment for them. Typical discounts we're seeing 15 to 25, usually on the lower end there right now, as it's kind of a startup friendly environment right now. Seen as low as 10, maybe up to 30, but again, typically between 15 and 25% there. And then fully diluted capitalization. This comes into effect more a little bit later stage companies when you have options outstanding, or if you have an equity incentive pool or a stock option pool that you're going to hand out to your employees, whether or not you're going to include those options and those restricted stock that hasn't vested yet in the determination of how many shares this investor would receive. This is something that's often overlooked, but it can make a pretty big impact on the founders and the investors as well, depending on the size of those stock option pools. We'll get into that a lot in the preferred stock, as VCs are usually negotiating this pretty hard. I'm going to stop quickly there and see if anybody has any questions on convertible notes. I know I ran through that pretty quickly. All right, it's very good. I'll talk quickly on like why you would want to use a note to do kind of initial financing for your startup. So I think the primary reason is notes are common. People understand them. Anybody that has worked in this space has seen a convertible note, and they're fairly quick, and also meaning fairly cheap from a transactional cost perspective. Attorneys, accountants, anything like that. There's not a ton to negotiate here. Like I said, there's those few kind of primary terms. When you get through those, the rest of it is pretty straightforward. And the big item here is you're avoiding valuation. So if you don't know what your company's valued at, or you're way off between you and the investor, you're really just kicking the can down the road for the next round. So again, notes are very common. I use these frequently, but I'll say they're kind of losing favor in some communities in favor of the safe, which we'll talk about next. But the note does take a little bit more time. It's a little more complex than a safe. And the important thing here, though, is it is debt. I mean, you either have to pay that back or it's going to convert over. And the key there for some companies, it really matters. It's debt on your balance sheet, so you need to show it that way. And on the other hand, jumping to safes, that's not really the case. So we'll talk about the safes here. So the safe was created by an organization called Y Combinator out in Silicon Valley. I think they started in 2013, maybe. So again, it hasn't been around that long, but it has really made a big impact in early stage financing and also bridge financing in between rounds. The idea here was, let's make a document that isn't negotiated by either side. It's fair to both sides. It's very simple. Just plug in a few the amount and some other terms, and you're done. In reality, it typically isn't quite that straightforward. As you guys maybe have heard in other attorney presentations at Venture Cafe, attorneys kind of like to negotiate. And so nothing ever ends up in a standard spot. But even Y Combinator has, I think, 4 or 5 different versions of their safe. So again, not really a standard document when you say, oh, we're just doing a normal safe. You really have to know, is there going to be a valuation cap there? Is there going to be a discount? Is there going to be a most favored nations clause? And is there going to be a combination of those? Because you can do any one of them, really, any sort of combination. And then they also offer a pro rata side letter to go with it. And we'll walk through each of these here. One big thing to note here, though, is this last piece: pre-money versus post-money safes. And the idea here is, if you have a valuation cap, that's going to be kind of the basement, or the lowest amount that the investor is going to receive once it converts over. So you really need to know, is that a pre-money or post-money valuation cap? Pre-money means, what is my company worth before the investor has put any money into it, or the round of investment? Post-money is going to be after the investment round closes. And it can have a pretty significant impact, especially early on in your business, where if you have a $3 million company pre-money valuation, and there's $1 million round coming in, it's going to have a pretty serious dilution effect, whether you're doing on the founders, whether you're doing pre-money or post-money. So something to definitely keep in mind. The Y Combinator safes have started out as all pre-money. They have now all changed over to post-money. So going from more founder-friendly to more investor-friendly, if you look at it that way. The reality of the situation is, safes are being used now for bigger and bigger rounds, where post-money is often the operative valuation cap that's being used. So the reality is that, the post-money is maybe the more accurate, the more appropriate figure to use here. So again, I kind of alluded to before, I think the safe is becoming more and more popular. I use it more often than I'm using convertible notes now. And I think that that's especially true in the Midwest right now, as it's becoming more and more accepted, I suppose, in the investment circles, as it's kind of come across the country from California. So the valuation cap, we've talked about that. The discount, similar to the convertible note. Same numbers are common. And the big difference here is the most favored nation clause. What that will do is allow an investor to switch to a new document if there's been a new safe or a new debt instrument in some cases. So if you have the initial safe, you sell to investor 1 at a valuation cap of $2 million with a 10% discount, but you give them a most favored nations clause. The second one, if you sell the safe at $2 million valuation cap but a 25% discount, that first investor could switch over from their first agreement to the second one. So it's something that's investor friendly. Of course, they're going to like it. They can pick and choose which agreement they want to use. But it's also, to some degree, it's really fair to the investor as well. If the startup is having trouble raising money and they have to get better and better terms, the initial investor really shouldn't be to their detriment in that case. So the most favored nation clause, in my opinion, works out pretty well for both sides. And jumping into why use a safe. Well, I've alluded to this, but this is really quick. I mean, we can put together a safe and sometimes have it negotiated within a day or two with the investor. So going from, yes, I want to invest, to money in the bank, it's one of the fastest ways to get there. And of course, that also means, less transaction costs again. So that's good. In a lot of cases, equity versus debt is important. I mean, you could have this run out for 5 years if you have to, or if you don't need more money. This is really just sitting out there. Whereas convertible debt, those due dates come, you have to make those payments, or at least the investor can call them and say, yeah, we want our money back. So safes are great in that instance where maybe you need a longer runway. And if you were to have to make that debt payment, it would either, seriously harm the company, or you'd have to go out and raise more money just to pay off the debt. That's not the case here. And then again, this is generally accepted throughout venture space. So, using the forms on Y Combinator as a start is usually pretty acceptable. I do say the caveat there. I think anytime you're raising money, please do talk to an attorney of some sort. These are pretty serious consequences, not only on your business's bottom line, but also with securities laws. So got to make sure you're following those. I'm not really going to get into any of that. We're just going to jump here from safe and into preferred stock. But again, I'm happy to talk offline if any of you guys have questions on securities laws surrounding any of these items. So preferred stock, quite a bit different than convertible debt and safes. This is kind of the holy grail of raising money from investors. Typically, when you're talking about preferred stock, you're talking about more money. You're talking about a more serious investor. You're talking about more due diligence, which means them looking into your company's past. You're just talking about a bigger deal, more variables. But this is what the investors, the venture capitalists, the VCs, this is what they're going to want. So preferred stock is a separate class of stock from common stock, breaking it down all the way. It's going to have different rights and different obligations in some cases to common stock. So the main differences we'll talk through on the term sheet discussion, but preferred stock is generally going to be paid out prior to common stock upon a change of control. That's really at the bottom line. Preferred stock gets their money back first. That's usually how it goes. And why is preferred stock? Again, if you want the big money, that's usually the way you're going to have to go. And usually, if you're raising multiple rounds, you're stacking preferred stock with different series on top of one another. So you may have heard of like a Series C, Series A, Series B, on and on as the company grows. They're generally very similar in their rights, but they are going to have different terms between those. Excuse me. Those series of stock. So getting the preferred stock deal done it's a process, and it starts with casual conversations often, where you're reaching out to investors, telling them you want to raise money. When you get one to bite and say, yeah, we're interested, send us a term sheet. That's one, time to talk to an attorney for sure. And two, it's time to have a term sheet ready to go or get moving on them very quickly. Some VCs will provide their own and say, this is how we want to invest, but you also do kind of need to be prepared with your own, or at least a very good understanding of the basic terms so that you know what you're getting once you receive one. So I have four items here. The main one I want to talk about at this point is just why use a term sheet? Why don't you just jump right into the agreements? Not to go too deep into history, but this kind of venture capital model is in the history of business is pretty short. Really 60 or 70 years of venture capital has kind of come to this point. Doesn't go back much farther than that. And the idea is agree on the main terms and let the attorneys kind of hash out the details. And so we'll go through those main terms here, but you're hopefully going from either, a 2 to 3 page document, maybe up to 5 or 6, depending on the complexity of the deal. And the attorneys are turning that into 100 to 200 pages worth of legal documents. So depending on the circumstances. So once the term sheet is done, you've really dealt with the hardest part of the deal. That's where the hard negotiations are. And if you get that right, everything goes pretty smoothly in most cases. So let's jump into kind of the economic terms of the term sheet. The main terms here are going to be price. This is the one that's always, the tagline or whatever when X company has raised money. How much money have they raised, and what kind of valuation does that give them? That's what you're dealing with here is boiling it down to what's the price per share, but it's what is the post money or pre-money valuation that you're raising at. And as I alluded to before, it has a lot to do with that fully diluted capitalization. Is there an equity incentive pool? A lot of times investors want to see that equity incentive pool and demand it. They know that you're going to have to hire new employees, whether it be a CTO or another, 3 software engineers to get your company off the ground, and they know that you're not going to be able to pay them market rates. So you have to give them some equity to bring them in and keep them there. So an equity incentive pool allows the investor to know what they're going to have after you have distributed those shares. And so they say, you need to have a 10% fully diluted equity incentive pool. What that really does is it dilutes the founders, but it allows the investors to know what they're going to have at the end of the day. So market that we see is 10 to 15 on the equity incentive pool, depending on kind of how many employees the company has, how many they are going to need, and with the money invested in that round. 10 to 15 is kind of the sweet spot, though. Two other similar terms, which are similar, are on the investor side: liquidation preferences and anti-dilution. So again, one of the best parts of having preferred stock is you get paid first. Well, liquidation preferences on top of that. So sometimes an investor will say, I'm going to give you $100,000, but if you sell the company, I'm getting 200,000 back. I'm getting 2x at a minimum before the common stock gets anything. This is very variable. Most of my deals recently have had no liquidation preference, or a single, I should say. They're going to get their money back first. But it's not uncommon to see 2x or 3x in these deals. So something to keep in mind for sure, because it will dictate whether you're going to sell the company for a certain amount, because you're going to get paid last as the founder with common stock. And then there's something called double dipping preferred stock. Not to get too complex, but they'll get their preference and then they'll also convert to common stock immediately before common stock gets paid. And so they'll get paid twice. So something to look for in a term sheet. And then anti-dilution. So if you have a round where your post-money valuation is 3 million, your next round of investment, it goes down. You have a down round, and it's maybe 2 million. The amount that the investors are going to receive from the initial investors, I should say, is going to go up. They're going to change the conversion mechanism so that they are going to have a higher percentage of the company based on their initial valuation. And then finally, something that is a difficult conversation with founders, but investors demand it nonetheless, is vesting. So a lot of founders start out vesting initially, and maybe they've run the company for 2 or 3 or 4 years, put in blood, sweat, and tears, and then the investor comes in and says, you're going to revest for another 4 years. Meaning you leave 1 year after their investment and you only get 1/4 of the shares that you had before the investors came in. Very common, usually non-negotiable. So, not a lot of reason to argue over this, but there is some ways for you to get a little better terms for yourself. And here it's often asking for, well, if I leave, I'm going to get a payment for my non-vested shares, whether that's fair market value or some predetermined price. It's not just a straight up, I'm leaving without any of those shares. But it's a harsh reality for a lot of founders when they hear that. So control terms are something that we look at very carefully, more than anything, because in a seed deal, you're really dictating what's going to happen in the next rounds. So if you're giving the seed investors a board seat, you can already bet that the Series A investor is going to ask for at least a board seat too. Similarly, if you give them a veto right for transactions above a certain amount, you're going to be giving those or similar rights to any Series A investor. So control terms are probably negotiated more than on the legal side than the economic terms, which are usually handled mostly by the founders. Board seats are typically asked for in a seed round, or a board seat, I should say. Just really depends on the investor though. So what we typically see after the round closes, you'll have 2 founders or a founder plus a key employee or some other person elected by the founders. So 2 founder board seats and a 3rd represented by the investors. That of course gives the majority to the founders, and the investors want certain rights. And so they often have some sort of veto rights here. And that could be, well, you can't sell the company without our approval. You can't go out and raise money without our approval. You can't buy another company without our approval. You can't go into a certain amount of debt without our approval. It's usually a fairly small list, but what we consider major decisions may be left up or maybe given a veto right. Similarly, protective provisions are usually included to the shareholders themselves rather than that board seat. So this is where some investors say, we don't need a board seat. We're just going to put more protective provisions in here. And so if the board of directors, the company wants to go make a major decision, they're going to have to go to the shareholders directly for approval. And again, those are going to be any major decisions, but also anything that negatively affects preferred stockholders. And that's specifically raising more money, trying to sell the company, or changing the terms of the preferred stock. Drag along rights are something that would allow the majority to force the minority to sell the company. So if the majority elects to do so, to sell the company, the minority owners have already agreed to go along with it. So that's what we mean by drag along rights. And then conversion to common stock. This is non-negotiable. Preferred stock wants to be able to switch over to common stock. It's very rarely utilized, but you'll see this come up ahead of a company going public or some other reason that would warrant the preferred stock trying to seek liquidity in the common stock. So I'll go through the rest of these fairly quickly and leave some time for questions on the term sheet. So dividends, in most venture deals from VCs or angels, they're not going to be asking for dividends, but it happens. And oftentimes they're rolling in the background. So you may have like an 8% dividend where each year, the amount that was invested, 8% of that gets tacked on to their liquidation preference. So they're going to get another 8% every year that preferred stock is outstanding. It's more common in the preferred equity role for you actually to be paying cash. Most venture capitalists want you to be reinvesting that money into the company to grow it faster. Redemption or put rights. This again is not super common, but it is included in some term sheets where it gives the investor the right to say, I want out, you have to buy me out for this predetermined amount. And they can elect that either within a certain window or after a certain time, like there may be after 5 years, we can get our money out. You have to buy us out. Information rights is included in almost every term sheet. Saying that the board of directors will deliver certain financial information or any material changes to the company to the shareholders, and that keeps them apprised of what's going on. Registration rights is talking about, hey, we want the ability when the company wants to go public or to put a public listing out to be first in line. We want our stock to go first. Or we want to have a right to make that decision of when we go public. A right of first refusal and then co-sale kind of go together. So the right of first refusal is going to say if a founder, well, that's usually the co-sale, but if the company wants to sell or a founder wants to sell their shares, they have to give that option to the preferred shareholders first to allow them to go and buy that stock from the founders, where a co-sale right is almost like sometimes called a tag-along right. The founder wants to sell 5% of their shares. They have to give the option to the preferred stockholders to sell with them. So if the founder owns 90% and the preferred stock owns 10%, that 5% being sold, 90% of it is going to be the common stock holder and 10% the preferred stockholder. So they're able to have a little liquidity there. There's usually a voting rights agreement that says how they're going to vote on certain things, the investors as a whole. And we can jump into that in a second when we talk about that. And then two things that are really key for the founders. The proprietary information and invention rights or invention agreement. Essentially, you're assigning all your rights in the intellectual property to the company. And that's not just founders, that's also all employees usually. And then another kind of sticky subject with some founders is the provision that says you guys are going to dedicate substantially all of your business time to this company. You're not going to go out and start another company. You're not going to go get employed by somebody else. If you're going to take our money, you're going to, commit to us. So that's negotiated from time to time, but depending on, I guess, the size of the investment and where the company's at. I'll stop briefly there and then just talk through kind of these definitive documents as we kind of switch gears to kind of closing the deal after the term sheet is agreed to. So when moving forward from a signed term sheet, the lawyers get involved and start drafting up documents. These are usually the 5 most common documents, and usually at least the first 2 in every deal are going to be included. The amended and restated certificate of incorporation is the document that you actually file with the Secretary of State. That's saying these are the rights of the common stock. This is the right of the preferred stock. You're saying there's this many, X amount of shares of common stock authorized, X amount of shares. You're usually, for the first time in a seed deal, you're authorizing preferred stock and then issuing it in the deal. So in a complicated deal, this can, be a 20, 25 page document. In other cases, it can be a little shorter, but usually the vast majority of that is just defining the rights granted to the preferred stock. Those protective provisions we were discussing, dividends, the liquidation preference, anything like that will be included in the certificate of incorporation. That needs to get filed prior to closing any of these other documents, because without that, all of these documents will be kind of void. You're going to be making promises in there that aren't true if the certificate of incorporation is not filed. And this really happens in a flurry. The certificate of incorporation might be filed in the morning of closing or the day before, but you're agreeing to all these usually at the same time. So the stock purchase agreement is where the investors are agreeing to buy their shares, agreeing to give the company money, and the company is agreeing in exchange to give X amount of shares of preferred stock for that money. But then the vast majority of this is, here are all the things the company is promising to the investors. You're representing that the company's in good standing, that there's X amount of common stock outstanding, that you haven't made any agreements other than those that you've provided to the investors, that you only have X amount of money in debt. You're telling them all of your IP. This is really where due diligence is documented. So all the due diligence that's involved will be summarized within this stock purchase agreement. This is probably the most complicated and most variable document here. And then the other 3 agreements here are, like I said, often included, but not always. So an investors' rights agreement will discuss registration rights and then any other special rights the investors are being given. Voting agreement is usually fairly straightforward. Who gets to vote for the board members? Is there any special mechanism where the lead investor might just get to appoint the board member rather than having a vote? All of the preferred stockholders need to agree to that in a binding agreement. So that's where it would be included. And then right of first refusal and co-sale, again, this is going to be a pretty limited scope document, but it centers around the transfer of shares, usually by the founders or any other key employees. So going from those definitive documents to closing is usually a pretty straightforward process once you have that signed term sheet. It may take 2 or 3 weeks, depending on the circumstances, from that first conversation with an investor to getting that signed term sheet. Once you have that done, the more in depth the term sheet is, the quicker definitive documents are created. And the quicker they're agreed to, there's just less variables then. And so you may take 2 to 3 weeks again on the term sheet. It may take just 2 or 3 weeks to move forward from there, to get the definitive documents, even though they're significantly longer and more complex. All the kind of key variables have been agreed to. Once definitive documents have been agreed to, it's really just a lot of procedural items of getting wire instructions, getting signature pages to all the documents, and holding those in escrow until everybody has agreed. Usually the lead investor and the company's counsel, but until everybody's agreed on that all kind of the closing conditions have been met. And then the funnest day comes where documents are released, wire is made, cash hits the bank, and the deal is closed. That is a very high overview, I know, of what happens in a seed deal. I'm happy to take any questions and would love to hear from you as far as where you guys are at and what kind of questions you have. Go from there.
All right, I think in the interest of time, we'll go ahead and end this session. I just wanted to say thank you so much to Casey for giving us this presentation. Husch Blackwell has a series with us, so they're here every single month. If you're interested in their events as well as venture cafes, go ahead to our website. And yeah, no, we're really happy that you guys joined us today. We have a bunch of other sessions happening today as well. So if you're interested, please join those. But other than that, once again, thank you to Casey, and we will hope you guys have a good rest of your day.